So in this video, we're going to show you how to calculate the debt to income ratio for a co-op in New York City. So if you're a buyer, or if you're an agent working with a buyer, or if you're a seller, or if you are a listing agent, this video will definitely help you. I'm Nick at Houseit. Check us out, houseit.com. We can save you money if you're buying, selling, or renting in New York City. Learn how by visiting our website, houseit.com, and do also check out our buyer closing cost calculator, which is available on our website as well. So let's go ahead and get started. So what we're looking at here is the REBNY financial statement. If you're not already familiar with this, it's basically one of the core requirements of an offer for a co-op in New York City. REBNY is a fancy acronym for Real Estate Board of New York. They don't really have claim to this form. It's a basic financial statement, but people call it a REBNY financial statement because REBNY is the predominant broker trade group here in New York City. So what we have here is a fictitious financial statement, and we're just going to go through it and kind of calculate the DTI and do the usual checks that we would do if we were working with a buyer, submitting an offer, or if we were a listing agent and we were checking an offer on behalf of our seller. So the first thing you want to do is just go ahead and focus on the income section. Now remember, your debt to income ratio has nothing to do directly with your assets and your liabilities. Obviously there's an indirect implication for liability payments like student loan payment and such, but the point is don't look at this section immediately to focus on debt to income ratio. We want to just go down into this section over here. So the first thing we want to do is just understand the income. Base salary is pretty vanilla, pretty straightforward. There's usually not too much we have to check on that. But other things like bonuses and commissions, this is a field that we may want to just double check with the buyer and just get a sense for how sticky this is. Ideally, there's a 2-year history of this income. Co-op boards like to see that stability. But if this is like an anticipated earnings, or if it's fully fictitious, or maybe it's partially based on last year with some sort of increase that you expect, but it's not written down, then you may want to discuss that. But for this particular exercise, we can just go ahead and include this as income. Now, dividends and interest income are also typically legitimate to add. However, if you're right on the border and it's a super strict building, I would be a little careful with this, just because presumably you're going to have to liquidate, in this case, some of your yielding stocks or cash or whatever. So it might actually, it's going to reduce that. So a really smart board member would notice that, and if they're being really tricky with their math, then that might be an issue. But in this case, usually you can just include it. Real estate income, this is an interesting one because it's not as common for somebody buying a co-op, especially a first-time buyer, to have an existing property. Most of our clients are renting in the city before they decide to buy either a co-op or a house or even a condo. So in this case, we do want to be a little careful with that. We would basically want to add this to the income, but then also make sure we have corresponding entries into the expense items for this particular purchaser. And then for other income, this is where red flags start to appear. We really need to understand what this is, because a lot of the times a purchaser may put something in here that's just really not going to actually count when it comes to the board application. So for example, if this 11,000 is projected income from a side hustle, or some sort of esoteric crypto type of thing, you probably should haircut it to 0, because the co-op board probably will as well. And similarly, let's say 5,000, maybe this is some sort of parental contribution, maybe towards student loans or something like that. Typically, again, it's hairy, it's complicated. Co-op boards won't really allow that. Now that being said, we have done deals before where we have a parent basically buying for a child, and the child's getting a stipend every month, and we've documented it copiously, submitted to the board, and got approval. But that's really more of an exception rather than the norm. So in this particular analysis, like if I was a listing agent and my duty was to my seller, I would, when calculating this, I would basically remove these 2 items for the reasons we mentioned. So in terms of income, that leaves us with having to basically sum all of this up. So again, legitimate base income, legitimate bonus, 2-year history ideally from your job, legitimate dividends from your liquid assets, and your real estate income, your gross real estate income from that property that you have. Let's just say it's a rental for now. And let's say it's, therefore you don't live there. So the total here is $357,000. So the monthly income will be that divided by 12, of course. And that gets us to $29,750 a month for their income. And then let's go ahead and look at expenses. So the first thing you want to do, especially as a buyer's agent or a listing agent, is you want to make sure that the projected expenses pertaining to the unit are actually correct based on the specific property, based on your offer price, and so forth. So if we take a hypothetical example of this property here on the screen, we can first of all see what the taxes and common charges are. And I actually added these up and divided it by 2, and that's typically what you should do. So if we sum that up, it's 725, and the sum of this is 725. So that's correct based on the specific property we're going to submit an offer on. And then the apartment financing, we used the calculator here on the site, assuming full ask. We just took the default interest rate. But if you have a pre-approval letter and it shows an interest rate, make sure you include whatever it is that you have on your documentation. And we have a mortgage payment of $3,439. And then what we did was we basically divided that by 2 and put half in one column for one applicant and half in the other applicant. These people are buying the property together. So that's what we have to do in terms of projected expenses for the property they're buying. Obviously, you don't include your current rent, since presumably you're disposing of that lease and you're not going to have that moving forward. So this is projected. And then unique to this particular revenue statement, as we mentioned, the buyer has an existing property. And so for that one, just to clarify, other mortgages, let's just assume that this is what the buyer confirmed to be their monthly payment, their mortgage payment. And then this property, let's assume also it's a house, so there's no common charges, it's not a co-op, there's no maintenance, but there are taxes, and let's just assume that the monthly taxes are $300 a month. So a lot of the times there might be a schedule, and this information will be on a schedule, but usually the buyer might put net rental income and it won't actually give us the specific information we need to surgically calculate the debt to income ratio. So now that we've done that, just to summarize, we have the combined projected carrying costs for the property we're submitting an offer on, split equally down the middle for both of the applicants. And then we also have the mortgage of $850, that's the existing property, he's going to make it a rental property now, and then taxes of $300. So just to put it in here, I can put that there. But also feel free to modify this as well. So oftentimes what we do to make it super clear, especially if a buyer has multiple rental properties, is we can actually label this. So you can change this. You can say, rental property mortgage, rental property 1 mortgage, and then perhaps here rental property 1 taxes. So feel free to modify this, and there are no auto loans in this case, so we can just rework this so that it's very clear, and we'll remove that. And so that makes it a lot cleaner. So if we sum all this up, it brings us to 5,314. Let's go ahead and put that there, 5,314, and let's make it look the same. There we go. And then let's just calculate the debt to income ratio. So it's as simple as taking your expenses and dividing it by your income. So it looks like it is 18% based on this calculation. Now, that being said, we do also at this point want to double check assets and liabilities. Why? Because oftentimes buyers don't necessarily include the associated payments, especially on the liability side, for entries here. And in this case, we actually do have this issue. So for example, real estate mortgages, that's solved based on the payment we secured here. But what about credit card loans? It looks like it's a large balance. And generally speaking, if you pay off your credit card balance every month, you don't put anything here for a co-op. But this is a large balance, so it looks like this is being carried over months. As a result, it appears on your credit report, and the co-op's going to want to know what the monthly payment is, the minimum monthly payment, as that does impact your debt to income ratio because it is a recurring liability payment. So in this case, we're just going to make this up and just say that the minimum payment is $250. So in the expenses, we'll just put credit card minimum payment and put there $250. And then the other thing we noticed here was that there was this line item for other debts, and there was no corresponding entry in projected expenses. So naturally we did ask the buyer, and the other debts were basically student loans. So we had to ask, what's the student loan payment? We got that, it's $300. So let's go ahead and put this in here. Student loan payment of $300. So just to recap what we've done here, we verified that things in the liability section also had corresponding entries in projected expenses. This one, real estate mortgages, we got that one here. Credit card loans, we got this one here. And other debts, which turned out to be student loans, we have that here. So if we basically add all of this stuff up again, it actually increases our DTI our expenses first, from 5314 to 5864. And therefore that brings our DTI up to 20%, which for a co-op is quite good. Typically a co-op in New York City, 25, 30%. If a building doesn't state anything, you probably better be below 25 to be prudent. Other times they might officially state 30% or something like that, but a lot of the times it's just holistic. So if your debt to income ratio is borderline, not obviously egregiously above, but borderline, and you have huge amounts of post-closing liquidity, which is the other metric for a co-op, then you'll typically be accepted. But there's no guarantees in this business with co-ops, and that's why it's very important to be very familiar with your debt to income ratio, understand how this is calculated, understand what a listing agent is going to do to it, because that's what a co-op board will do when they dissect your board application after you're in contract. So we hope you found this to be helpful. Let us know below if you have any questions or comments, and remember, we can save you money on your purchase through a buyer closing credit. Visit our website to learn more, and do check out our closing cost calculators. The link is below in the description. I'm Nick at Houseit, and we'll see you on the next one.